Hey everybody, welcome to your weekend review for the week of Monday, September 19th, 2022. New week, same results. MBS started the week losing money early, down 37 basis points very fast based off of overseas activities. The 10-year yield topped out at 3.518 overnight, with the U.S. suffering the ill effects of several scheduled market closures. This led to a crash in treasuries right when the U.S. markets opened up. U.S. equity futures slid early as stocks were down this morning, though the S&P ended up being up 26 points on the day. The dollar did rise. The weakness of the market reflects expectations, stop me if you've heard this before, of an oversized interest rate hike leading us into a recession. Yeah, it's just going to happen. No reason to worry about it. It's just going to happen. Investors also face potential volatility from policy decisions from the Bank of England and the Bank of Japan and several other central banks. The Federal Open Market Committee meets on Monday and Tuesday. The Fed futures rate is about an 80% chance of a 75 basis point increase, with a 20% chance of a full point. The yield curve continues to invert. The 2 to 10 spread is now at 46 basis points. Investors are pricing in the first Fed rate cut come in May of 2023. So that's where they figure the recession will be bad enough that the Fed will have to come back in and undo what they're undoing now that they did before. Like I said, bonds were down 37 basis points early. They kind of rallied throughout the day as things went on, and to be down 25 basis points. So rallied to be down just 25 basis points. They're once again fighting with that floor of 99.266. I got a feeling that's going to be a fight we're going to be dealing with all week as we head into this Fed meeting. And at that price, we're getting really close to switching coupons, although there isn't much premium left in the 5.5. So depending on what happens from the Fed and the dot plot, we could just skip over the 5.5 coupon and go all the way to 6. Another interesting side note is the rapid pace of rate hikes has resulted in an interesting statistical anomaly. The months of supply in terms of inventory of homes has jumped to 4.1 months from a record low of just 2.1 months worth of supply back in January. As a reminder, 6 months worth of supply is considered healthy. So we're still below that, though going from 2.1 to 4.1 is actually historically rapid increase in the amount of months inventory on the market. Seems like a broken record because Tuesday, September 20th started like all the other days with a sharp downturn in the MBS market. MBS were down a fast 47 ticks right out the gate. Heck, they lost 10 basis points while I was writing my morning posts. Yet another record-setting inflation report out of Germany. I'm starting to feel like people don't like inflation. A bigger than expected rate hike in Sweden wasn't necessarily a key consideration, but sure as heck didn't help things at all, did it? Home buyer sentiment fell 3 points to 46. I'm getting a little sick of their pessimism, to be honest with you. Present conditions fell 3 points. Future outlook down 1 to 46. Traffic was down 1 to 31. 50 is said to be kind of a break even in terms of good versus bad. I think they're a bunch of whiny babies. 24% of builders have done some price reductions. August starts were up 12% at a 1.57 pace. After a downward revision to July, they were up 8.6 total once you net out the revision. Now flat year over year. Single family residence starts were up 3.4%. Home builders, I mean, come on. You're selling homes at a very high price and at a rate about 3 times the pace you can even build them. I mean, if your sentiment is that low with those kind of market conditions, go have a big old glass of shut up. Redfin announced they're seeing 22% of homes doing price reductions, which probably makes a lot of people want to jump off a cliff or freak out and panic. However, then again, you look, and in 2019, about 20% saw a price reduction, so not abnormal. The big thing to look at, too, not only in terms of house prices, is owner equivalent rent, which is a big input into inflation numbers. So the Fed would love to see some home appreciation slow a little bit. Median asking rents rose 14% year over year in July, according to Redfin. This is a deceleration, but still very, very high. The problem for renters is that there is still a shortage of housing units, and rising rates are pushing would-be buyers into the rental market, but then again, the rents are going up, so that might push them back into the housing market. 20-year auction today was graded a B. Bid to cover was 2.65, was above the 1-year average at 2.48. Direct and indirect bidders took 91.9% of the auction compared to a normal of 84. Like I said, we were off 47 basis points early as the day went on. I guess everybody decided things weren't that bad, and we closed the day being down 14 basis points on the 5% coupon. We've now started paying attention to the 5% coupon versus the 4.5%, which took an even bigger hit, is now down 97. So at 99.22, we might run right through that pretty quickly. But you can see on the 5% that we have broken through, and we're kind of hovering right around this floor at 99.125. We ended up on the positive side of that, so that is good. And we're going to have to watch this new coupon as we go along. We also got a post from our sponsor at www.WellThatMakesSense.com. New book, new information, new learnings. This is from The Innovator's Dilemma. Great book about how companies miss to see innovation that ends up capsizing their entire company. One of the key points is that oftentimes the completely competent decisions by a company's executive will actually lead to their demise. So find out about that, find out about how that happens and how to prevent it in your company by going to www.WellThatMakesSense.com. And Wednesday was a predictably wild day on the bond market. We had a positive open with the MBS being up 17 basis points early, and stocks were up 23 points as well. Existing home sales slipped a bit, being down 0.4% in August. They're now down 20% year over year. The median home price rose 7% to $389,500. Housing inventory remains low with 1.28 units, which is 3.2 months supply. However, 39% of that is actually under contract, so there isn't much out there to buy. Days on market came in at 17, an uptick from July, but down from a year ago. 81% of homes sold within a month. That's pretty high. First-time home buyers were 29% of sales. Cash buyers were 24%. Investors were 16%. And then we got the Fed decision. So the Fed hiked rates by 0.75 of a point. The median forecast shows rates of 4.4% at the end of 2022. We also got an updated dot plot where it's saying basically from the Fed, they are estimating a range around 4 3/8 at the end of this year. Into next year, 4 5/8. So even some more rate increases in 2023 before the recession kicks in, and they have to start doing stimulus to bring it down to 3.875, and then 2025 all the way down to 2.875, which kind of to me sounds like they are anticipating a multi-year recession. Longer run, it's 2.5 with a range of 2.25 to 3. The Fed is saying that they're going to have to do some more hikes in order to quell inflation and then probably go into a recession. Like I said, we started out being up 17 basis points at one point. Quickly after the Fed decision, we were down 20 basis points to end the day being up 3 basis points on that 5% coupon, which is what we're now paying attention to. We're right in the middle of that big fat range of 100.531 on the ceiling and 98.516 on the floor. So that can make for some bumpy rides with a wide flow like that. Existing home sales have declined sharply to sit nearly 30% below the January 2021 pandemic peak of 6.65 million and about 10% below the 2019 average of 5.24 million. Over the last year, home prices have climbed another 13%, and combined with increases in mortgage rates have caused the cost of home ownership to surge 48% year over year and 79% over the last 2 years. And we're definitely seeing it in the market now. Thursday, September 22nd, 2022. Oh, you September 22nd. Gonna have to come up with some new words to describe the bad bond market openings. So today I'm gonna say that the UMBS 5.0 was taking a drubbing early, and it continued all day. MBS was down 64 basis points really early. Again, we lost 10 basis points while I was typing up my morning social media posts. While the 75 basis point hike by the Federal Open Market Committee was not a surprise, their plan to raise rates another 125 basis points over the next two 2022 meetings was a surprise. They are now finally forecast the unemployment rate to rise to 4.4% by the beginning of the year, a rise of almost 1 percentage point from its 722 low. That large of an increase almost always is accompanied by a recession. So those that had any hope of having a soft landing are waving their white flag, as they should have done a while ago, in my opinion. The median consensus for June was that the Fed funds rate to end of the year would be in a range of 3.25 to 3.5, and to end 2023, which is next year, in a range of 3.5 to 3.75. This was bumped up considerably yesterday. The voting members now see the end of year Fed funds rate at 4.25 to 4.5, which is a big difference, and 2023 ending range to be 4.75 to 5%. Again, big increase. The economic projections were tweaked as well, with 2022 GDP revised material lower from 1.7% to 0.2%. Since the GDP was negative in quarter one and quarter two, that seems pretty optimistic. The unemployment forecast was revised upward as well to 3.8% for 2022, 4.4% for 22, 4.4% for 2022. They see inflation coming in at 5.2% this year in total. I don't know about the math on that this year, and they're gradually getting back to their 2% target by 2025. Wait, 2025. Okay, we've been saying this for a while. This is a multi-year process, just like it was in the 80s. So this sent all of the blue check marks on Twitter into a frenzy. It's going to cause a bunch of political ramifications, so we'll have to see how that plays out. The Fed anticipates core PCE to be 4.5% by the end of 22, which is not good. I don't see how we get to a 0.2 GDP. I don't know how we end up in a positive number this year. There's going to be some weird numbers on that. And like Brent Niatre said, the NBER, who is the technical ones who declare things a recession or not, are going to have to find a way to bird box this one into not calling it a recession. We're going into a recession. Just accept it, folks. The December 2023 Fed Fund futures see rates at the same level, and we are close to the end of this process. On the question of active mortgage sales by the central banks, nothing said yesterday changed our view that it won't happen at worst, and it'll be a 2023 event, so they probably won't sell MBSs this year, just continue to not reinvest the runoff, which is fairly low right now. The U.S. weekly jobless claims rose 5,000 to 213,000 this week. The estimate was 217,000. 4-week moving average is 216.8 thousand. In the week ending September 17th, prior jobless claims was 208,000. So it's up a little bit from last week, still pretty darn low. The market did not like anything it heard today. The MBS 5% was down 112 basis points, which puts us well below that floor of 98.516. And even the 5.5 coupon, which is the next one up, is below par. So we better get a 6% coupon out and get some liquidity in that in a hurry if we want to see premium pricing available. But this is a rough day, any which way you look at it. Fannie Mae updated the origination forecast to $2.44 trillion in 2022 and $2.17 trillion. That should be T instead of a percent, although it feels like a percentage. In 2023, about a 40% decline from 2020 and 2021, though historically this is plenty enough for you to earn a great living. You're just going to have to get out there and try harder, unfortunately. And another bad opening on Friday based off of a lot of data out of the UK of them reacting and making changes in their economy. MBS got hit to the clip of being down 22 basis points very early again. Lost, I think, 7 or 8 basis points while I was typing my first post this morning. Stocks, not socks. Stocks are losing pretty big. Being down 61 points in the morning, ended up being down 64 on the day. Stocks were lower as people adjust to the new reality of higher rates. Goldman Sachs has cut their target for the year-end S&P 500 from 4,300 to 3,600, which is pretty much where we're at right now. Commodity prices are beginning to reflect the lower growth forecast as well, with oil dropping below $80 a barrel. Those who like to move around will like the idea of that. U.S. businesses are reporting a third consecutive monthly fall in output during September. rounding out the weakest quarter for the economy since the global financial crisis, if you back out the pandemic, which had to do with disease. A total of about 115,000 homes were flipped transactions last month, or 8.2%. This is a decline from the first quarter, but is still an increase over the second quarter of 2021. At the end of the day, we ended up being down 3 basis points on the day, ending up at 98.09, which is pretty consequential considering that our floor was 98.043. Early on in the day, we were well below that, which was looking pretty ominous. So apparently as the day went on, a bunch of traders decided, no, that floor is the floor. We're going to buy some stuff and head to the beach. So we closed the day above that line, which is good. So the floor of 98.047 has held up. Give us a little bit of something. We got to take our wins where we can get them. In terms of wins, you can also check out and learn some new stuff over the weekend by going to our blog sponsor at WellThatMakesSense.com. Today the book is Innovator's Dilemma. The product life cycle is functionality, reliability, convenience, and ultimately to price. So basically, when a brand new product hits the market, everybody's going to pay attention to the functionality. What does it do that is different? Then it'll be reliability. How much can I count on it to do that? Convenience. How easy is it? And then ultimately landing on a competition over price. Check it out at www.wellthatmakessense.com because it makes sense. Looking into next week, the economic calendar, we have a bunch of big dollar signs on the agenda. So on Tuesday, we have the durable goods order, which goes into CPI. We also have a 5-year note auction, 2 and 7-year note auctions on Wednesday. We get the final Q2 GDP number on Thursday. This is consequential because it will go into whether or not people admit that we are actually in a recession or going into a recession. And odds are it's going to show negative growth, which will be 2 consecutive quarters of negative growth, which isn't the only component into declaring something a recession. However, it is one of the bigger ones. And then on Friday, we can all freak out, panic, and lose our minds before the weekend because we get core PCE inflation number, as well as consumer sentiment and 1-year and 5-year inflation expectations. So rest up this weekend, maybe go learn some new stuff. Check out our common influences and sources. WellThatMakesSense.com is a great one because it makes sense. And then also all the ones you see here. Hope you have a great weekend. Be safe.